I said mortgage rates would drop, but they still haven't. So will they drop? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here's the market data that you need to make an informed buying or selling decision or help a client do the same. The best place to start this month is with inventory. The question is, will inventory improve for the spring housing market? Let's start off with a quote from Realtor.com. The inventory of homes actively for sale increased in 45 of 50 of the largest metros compared to last year, and in 4 large metros, inventory was above pre-pandemic levels. So we're seeing active inventory growing, and if you look at this chart showing the overall change year over year, comparing March this year to March last year, you see the national average of 23.5% growth in inventory. And as you look across the country, depending on the state where you are right now, you can see how much inventory has grown. In a few states, inventory contracted, but the overwhelming majority of states show that they have more inventory today than we did last year. And that's certainly a good thing. Now, if you're in Florida like me and you see that 57% increase in inventory in 1 year, you might ask, well, how can that be a good thing? Surely that's not a good thing for home values. Well, it depends, because 57% more of a little bit is still just a little bit. We still don't have enough inventory. And here's what I mean. Remember the years 2017, 18, and 19? I remember those years as just blah. There was nothing special to remember them by. Rates were kind of normal, values were kind of normal, transaction volume was kind of normal, nothing major to remember. Well, guess what? Even after this large year-over-year increase in inventory, we still have today nearly 40% less inventory than we had back then. To be exact, 37.9% less inventory today than we had in the years leading up to the pandemic. So if you come across someone running around with their hair on fire and screaming that inventory has doubled and that the 2008 apocalypse is back, feel free to put them in their place with the facts or just show them what Realtor.com had to say about this. For the first 3 months of this year, the inventory of homes actively for sale was at its highest level since March 2022. However, while inventory this March is much improved compared to the previous 3 years, it is still down 37.9% compared to the typical 2017 to 19 levels. They went on to say, providing a boost to overall inventory, sellers turned out in higher numbers this March as newly listed homes were 15.5% above last year's levels. This marked the 5th month of increasing listing activity after a 17-month streak of decline. The fact of the matter is more people are stepping out and listing their homes. More people that didn't make a decision last year to list their home are doing so this year. Lastly, the chief economist at Fannie Mae said this. Consumer attitudes towards home selling conditions increased markedly in February, with current homeowners in particular expressing greater optimism that it's a good time to sell, a development that may foreshadow an upcoming increase in existing home listings. Let's now move on to the topic of mortgage rates. I found an interesting quote from Forbes which said this. Current expectations are that the Fed will start to cut rates some point between June and September. The exact timing depends on how incoming economic data looks. The Fed's March meeting did not set up the prospect of a near-term interest rate cut, but a summer cut appears likely. Now, I said I found that interesting, and here's why. I'm recording this in mid-April, about 1 week after the most current CPI reading was released. CPI is the Consumer Price Index and is one of the metrics we use to measure inflation. And this CPI reading, I must admit, surprised me. It confirmed to me that inflation is proving to be way more stubborn than we originally anticipated. And I'm willing to bet that whoever wrote that at Forbes would be willing to walk back part of that quote. At the time they said this, rate cut odds for the Fed's June meeting were probably around 60%. Since that CPI reading, however, those odds have fallen to just 20%. So the Fed finds itself in a very tricky position because it wants to cut rates. They've openly said they want 3 rate cuts this year, and yet economic indicators are not helping them. And what makes me want to break out the popcorn and enjoy the movie is the fact that we are in an election year. And there is no doubt in my mind that the White House is pressuring the Fed to cut rates. It's a fact that in an election year, the incumbent administration always tries to paint a rosy picture regarding the state of the economy to maximize the chances of re-election, of course. It happens in every election year. And one such way to do that would be to get the Fed to cut rates and let the stock market keep flying. But inflation is not cooperating and giving anyone the political cover to do such a thing. So, what's the one thing that could get us a rate cut? I think weak employment numbers. I think we still get a rate cut this year, but I'm not so sure anymore that it will be because of lower inflation readings. It's going to take weak employment numbers for anyone to have the political cover to drop rates because it doesn't seem inflation is going away soon. Case in point, Jamie Dimon, the CEO of JP Morgan Chase, in his recent annual letter to shareholders, made the case for stagflation, which is when you get a recession with lingering inflation and therefore stubbornly high rates, which is double trouble because normally in a recession, a central bank will look to cut rates to kickstart the economy back into growth. But they can't do that if inflation is too high. This, of course, makes my previous calls for rates to be under 6% by the end of the year to be a bit questionable, if I must be honest. And the situation in the Middle East is not helping because we can use the price of oil as a leading indicator for inflation. Conflict in the Middle East makes oil more expensive. And if the price of oil doesn't come down, nor will inflation. But that doesn't mean I believe rates are going much higher, however. I still think we are in a downward trajectory, just not as favorable as I thought before. And I think that's an important segue to make as we bring up the topic of affordability. Take a look at this graphic from the National Association of Realtors on the Housing Affordability Index. The higher the index, the more affordable a home is. So the lower the index, the less affordable a home is. And as you can see, we are currently in a period of affordability that is worse than anything we have seen since 1990. Not so long ago, we were in the most affordable periods. And now, due to the fastest rise in the 30-year fixed mortgage rate that we've ever seen, we've done a full 180 on affordability. So what's my point? Why am I telling you all of this? Well, I find it interesting that despite affordability challenges, prices have remained stable and slightly increasing. Makes me ask the question, what happens when affordability improves? Well, first we need to understand what the components of affordability are, which are wages, mortgage rates, and home values. As I said, home values are stable. If they were to decrease, that would improve affordability, but they are not decreasing. So that leaves wages and mortgage rates. Well, wages are climbing at a faster pace than they have been previously. This graphic goes all the way back to 2006 and shows the trajectory from the Fed of weekly wages. People are earning more money. And I think we know that because people have to make more money because prices tend to go up over time. So that brings us to mortgage rates, which I have already discussed are in a downward trajectory. So we certainly have the right ingredients for better affordability, and we need to be aware of that because as affordability improves, the market will become more competitive. If I'm a potential buyer, I would really find that information useful. That's a wrap for the May Market Report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.